Hello, everyone. I have today with me David Rogovic, who is Vice President and Senior Analyst at the Sovereign Group of Moody's Ratings. And David has been kind enough to join us today to talk about a recent report issued by Moody's that discusses how sea level rises affect credit ratings, sovereign credit ratings. And today we will talk mostly about how those sea level rises affect the sovereign credit ratings of the sovereigns that in the Caribbean that Moody's rates. There are quite a few of them. We probably won't be able to touch on all of them, but I'm so happy to have David again here. Welcome, David, and thank you for joining me.
Oh, thanks for having me, Marla.
So, David, perhaps what you can do is just give us an overview and some main highlights of the report, and then we can get into a discussion of the main issues that I want to talk about.
Yeah, sure. I think this is a really important issue that's getting more and more attention from the investor community, from issuers when we meet with them. But the summary of the report is basically over the past years, we've seen an increasing frequency and severity of natural disasters that are associated with rising sea levels. And at the same time, we are seeing governments take steps to attempt to address these challenges. But what we found was interesting is that when we looked at the subject, what we found is that sea level rise is almost certain to continue into the future and at an accelerating pace. So regardless of what's done now, there will be a certain amount of sea level rise that will continue into the future. And along with this rise in sea levels, we're likely to see an increase in the frequency and severity of associated natural disasters. So from a credit perspective, we looked at there are really two angles to it. One is the impact of this gradual but predetermined rise in sea levels that will occur over time, over many, many years. And the other is the more intermittent natural disasters, the flooding, the heavy rains that will occur at a more frequent basis and more consistent basis into the future because of the rise in sea levels. And from a credit perspective, we're really focused on these intermittent weather events that we can look at to see the effect that has on a sovereign credit profile. So there are two main channels of transmission from weather events to the sovereign credit profile. First is on economic strength, and then the second is through fiscal strength. And natural disasters, obviously, floods, rains, cyclones, they result in a contraction in economic activity, either because it affects a sector like tourism or agriculture. It also reduces spending on other areas of the economy, and it worsens the debt burden. And then during the reconstruction phase, you also have spending taken away from other areas like development or social spending to then be spent on reconstruction efforts. So it's really these two main channels. There's also, of course, the social impact, the loss of life, the forced migration that can have an impact in certain cases as well. But we look at economic strength, fiscal strength, and this last, social implications as well. And when we try to judge the materiality of this risk to climate change, of this risk to weather-related events and sea level rises, it's really a combination of vulnerability and then how susceptible a sovereign is, or how capable a sovereign is to address the impact that results from these events.
Right, and overall, your report indicates that in the first place, there are locked-in sea level rises, meaning that regardless of what we do from today going forward with respect to carbon emissions, there is a certain amount of sea level rise that will still happen irrespective of that. And
That's right.
the second, right, which for me was I suppose, most frightening part of the report, because it I guess gave a sense of hopelessness, that, even if I live on the coast in Barbados, and it frightened me that, because I'm always in my head thinking, what's the solution? What's the solution? And if you're saying, if this report, based on which of course is not research, Moody specifically did, but research that was done around the quantum of sea level rise, if this is indicating that really there is nothing we can do, for a certain amount of locked-in sea level rise, I found that very, very frightening. And the second thing was that overall, this these sea level rises and climate impacts have an overall they're credit negative for all sovereigns. And so it's I suppose, a double whammy for us in the region, and it's almost inescapable. I mean, the last question of the five that I wanted to discuss with you was just around how do we solve that, but maybe we leave that for the end, and
Yeah,
we can go through the questions that I had on the report. And the first one was, the report identified that um, the most material credit risks were to the small islands and other countries like Vietnam, Egypt, and Suriname. And I just want to ask a question. Now, we understand why small islands will be most susceptible to rising sea levels. But you want to explain to me why Suriname, please? Because I mean,
sure.
Suriname has this huge hinterland, and so one would assume that they can, more so than a small island, insulate themselves from the effects of rising sea levels by moving inland and moving to higher ground. Whereas some islands, like the Cayman Islands, for example, I think their highest point is something like 60, is it 60 meters or 60 feet above sea level? So there's really nowhere
Yeah.
to go. So why Suriname?
Yeah, no, I mean, of course, Suriname is not the first country that comes to mind when you think about sea level rise. It's natural to think about some of the smaller islands in the Caribbean and the Pacific. But so we looked at previous research that was done on this, and basically the research will look at different scenarios for how high sea levels will rise into the future and at what pace. So a lot of them will look at where will sea levels be in 2100 versus today, based on either a current trend of carbon emissions of greenhouse gases continuing. Other ones will look at if there's a slowdown, if governments and the globe take steps to reduce the pace of carbon emissions going forward. But so there are different scenarios, and you can see where they'll be, let's say in 2100. And to assess the impact, or to assess which countries are most vulnerable, you would look at the share of the population or the share of land that's within either 1, 2, 3 meters of sea level. You could also look at other factors like economic activity. The IDB, for instance, looked at the share of internet activity and how far that occurs from the sea line. So there are different measures to it, but Suriname comes up as one of the most vulnerable. And why? If you look at Suriname's coastline, most of the activity occurs in Paramaribo in the east and the coastal region on the east, and something like 2/3 of the population lives within 2 meters of sea level. So it's that concentration of economic activity, concentration of people in the low-lying portions of the country that make the country vulnerable to sea level rises. In particular, it's also the intermittent risk of coastal flooding. So, 2008, there was a severe flood across the eastern coast of the economy of the country, and something like 65% of crop production was affected by it, and I think nearly all of their fishing activity was also affected by it. So, you think about the sectors that would be most vulnerable, it's going to be agriculture, fisheries in the case of Suriname, but it's really this highly concentrated concentration of economic activity, population, land that's on the coast that makes Suriname vulnerable. I mean, a more general point is, we think about sovereigns and their vulnerability to sea level rises and the impact on more frequent weather events over time. It's really, smaller ones who are less diversified, highly concentrated activity in one or two sectors, with a lot of activity occurring at low-lying levels of land, so close to the sea.
No, and that makes absolute sense. And thank you for explaining that. And I know that Guyana, for example, is not one of the sovereigns that you rate, but Guyana is increasingly, I guess, in the limelight in this region simply because as of end of 2019, they're now an oil producer. And this year will be the fastest growing economy in the world. And I just wanted to make the point that I know you may not be able to comment simply because you're not you don't rate Guyana, but Guyana has similar conditions to Suriname in terms of proximity of the majority of the population to the coast, the amount of dependence there is on fisheries and on agriculture. And even the other parallel I want to draw is that you have the sea level, that's one thing, but remember that there are these huge rivers that
Exactly.
traverse the country, and those, I would imagine, the water level in the rivers as well would also, and Georgetown in Guyana is actually below sea level. So all of this, when I was reading this report, even though it doesn't reference Guyana, in my
Yeah.
mind, I was just thinking, oh my God, what's going to
Yeah.
happen in Guyana, you know? So that was also quite alarming to me. So thanks for explaining um, more in more detail why Suriname could be affected. And the second question I have is around, in your analysis of what locked-in sea level rises
Mm.
look like, you particularly highlight the Cayman Islands, where they're with 80% or more of the population exposed. What exactly, explain to us what this locked-in sea
Mm.
level rise is all about. Um, and 80% or more is very high for Cayman, but they do have fiscal buffers, as you highlight. Uh, what degree of storm would you say, or of what quantum of damage in terms of the dollar value would you say would warrant a downgrade? Because Cayman Islands, I think, is the highest rated, well, not sovereign, but government in the region. What would you say would trigger a downgrade? Just to give us a sense of what quantum is required.
Yeah. I mean, so as I explained, the idea of locked-in sea level rise is this idea that regardless of what we do going forward, sea levels will continue to rise over time, and
No matter
without putting
what.
an end date on it, no matter what, right? Sea levels will continue to rise. So we
Mm.
know at some point in the future, just without being able to specify the time period, that this will occur based on what we know. And this is, based on no changes in greenhouse gas emissions. So if they're curbed, could occur at a slower pace. But this is very, very long term. What's interesting about it, again, from the sovereign credit perspective, is that uh, we tend to find that this is highly correlated. So the countries that are most vulnerable to this locked-in sea level rise are also the ones that are most likely to experience more frequent, more severe weather events. So hurricanes, flooding, storms, uh, over time. So that's the part that we're focusing on. And as you mentioned, Cayman does have buffers, right? And I think I can give you an example. Might be the best way to explain the quantum of how severe a storm can be without seeing a credit impact in the case of Cayman Islands. Hurricane Ivan in 2007, right? The economic cost of the storm was estimated at something around close to 200% of GDP, right? 80% of the housing stock was affected by the storm. But
Mhm.
when you look at the credit metrics, you barely see it's not noticeable in the credit metrics over time. And that's because of the high level of private insurance, for instance, in the business and the government sectors in particular. Um, so it does highlight how important these buffers are. The country also
Yes.
has very low debt levels, relatively wealthy, even if it is a small island.
Yes.
But so those are the buffers. But again, you can't take away from the fact that I think it's the average height above sea level in the Cayman Islands is something like 7 feet. I mean, it's very low, very flat. So, the majority of along the coastlines, it does create a vulnerability. But again, it's a combination of this vulnerability and the buffers and the ability to respond to shocks. And so, I mean, taking again Hurricane Ivan as an example, it's quite a large storm, quite a large economic impact, and yet the credit impact is very small. So what we've said in the past, and I think holds true for Cayman Islands, is it's exposed, but it has significant buffers that mean that the impact of a storm can be contained in most cases.
Thank God. One positive
Yeah,
thing here, right? And then Hurricane Ivan was, I mean, it was devastating, but luckily it wasn't followed in quick succession by another disaster the way
that's true.
Maria quickly followed Irma in 2017. Um, So I suppose it makes the point too that if it's not too frequent, um, perhaps we can contain the effects. But when it becomes very, very frequent, which the report highlights is already baked in, that
That's right.
that there will be greater severity and greater frequency of these storms simply based on the sea level rises and the temperatures and so on. That means that perhaps this is not that might Ivan might be an anomaly, or might have been an anomaly in more sense than one, but we'll see. Um, so the third question I had was around where it was stated in the report that the greatest inundation by proportion of land area would be in the Bahamas. Does this have a greater or lesser impact on ratings than the impact on population? Um, and is there a quantum of damage that would warrant a downgrade on the Bahamas?
Mm. Yeah, no, it's a good question. I mean, we looked at a range of factors, and so whether it's population, land size, economic activity, they're all really proxies for, it's a proxy for economic infrastructure for the how concentrated economic activity is one area. So land versus population, it's hard to say one versus the other.
Mhm.
But again, I think it's an idea about how much of the crucial economic infrastructure, how much of the crucial economic activity that generates growth or generates GDP it is exposed or is vulnerable. So we just talked about Hurricane Ivan, but in the case of the Bahamas, we can look at Dorian,
Mhm.
right, and the impact that had. And so, of course, it had a severe impact on the country, significant damage to parts of the country, but New Providence and Nassau were really spared the worst of it, right? And if you think about
Mhm.
where the main international airport is located in New Providence, if you think about the majority of tourist arrivals come onto that into Nassau, that's where the majority of economic activity occurs. So,
Right.
from the sense of the severity of the storm, I mean, there's no doubt it was a severe storm, but these are the details that matter. So the fact that Nassau was spared the worst of it in some ways limited the impact. The other factor for the Bahamas, right? We're talking about something a credit that's in the middle of the rating range at Baa3. They do have some mitigants that can offset the impact or the negative implications from a storm. So similar to Cayman, wealth levels are relatively high. There's
Mhm.
insurance coverage, at least for the tourism sector, for the business community, although not as much in the private sector. Um, so these factors are important to consider as well. Also, the one thing we haven't discussed yet, policies and institutional capacity to respond to these shocks, right? I
Right.
mean, Bahamas has been proactive in terms of putting together a financing package, whether it's IDB credit lines, insurance, the disaster fund, that all help smooth out the impact of a storm, of a weather-related event, of flooding. That immediately after a storm, when reconstruction efforts start, they don't have to divert resources from other parts of the budget. They have financing that's lined up that really helps deal with the short-term liquidity buffer, liquidity risk. Um, the other factor, prevention, right? We haven't talked about that either, but they're also something that most governments tend to focus a lot more on the recovery efforts and having financing. But Bahamas is also doing, taking measures to try to prevent the impact of storms, right? So they have
Right.
with the IDB funding for some infrastructure measures to help mitigate things. So building seawalls that really would help to insulate the infrastructure, insulate the economy from not necessarily a major storm, but at least the more frequent, even if lower severity storms
And sea
that can
level
occur.
rise.
Yeah. But
Yeah.
in terms of the rating, we were just talking about Hurricane Ivan in Cayman Islands, and you said that they were, in some ways, there's a benefit that there wasn't another storm immediately after, right? And that's something that, over time, if we did see more frequent storms occurring and have that having an impact on the debt level, um, over time, that would be something that we would be looking at in any sovereign, but in Bahamas as well.
Indeed. Um, and just to go back to Guyana for a
Mm,
second, where in your report it says that after the Netherlands, Guyana has the most exposed population. according to a 2017 chart you had in your report. And yes, we know that Guyana is not rated by well, any rating agency is, at this point. Well, what are your thoughts? So we spoke about, land effect versus, well, land in general, but land where most of the economic activity takes place versus population. And this point made that after the Netherlands, Guyana has the most exposed population. So in one way, Guyana is seeing, I guess, tremendous growth and opportunity in the energy sector, and on the other hand, massive vulnerability to the sea level rises and to natural disasters as a result of that. What are your thoughts on Guyana, and particularly around what's happening there now? What can they do from a policy perspective? I mean, you just discussed some of the things that Bahamas is doing, but what are your thoughts and what would be your recommendations for Guyana?
Yeah. I mean, I can't comment too much on Guyana. Like you said, we don't have a rating on them.
Yeah.
Looking at the reports, obviously, in a lot of ways, very similar to Suriname in terms of population. You mentioned Georgetown is actually below sea level. So, I mean, that's where the vulnerability lies. In terms of what can governments do in general, or what we're seeing governments do to mitigate some of the risk. When we talk about Bahamas, but there are other ones too. Jamaica is developing a natural disaster risk financing strategy, right? They're trying to build buffers worth $1 billion, like a little bit over 5% of GDP, if I'm not mistaken, right? Again, to help with the recovery efforts, to help smooth out some of the post-disaster liquidity pressures that might emerge. When you talk about catastrophe bonds, if you want to talk about those as well, it's something that you're seeing more and more governments use or look at least explore.
And would you say that kind of, so the catastrophe bonds and this fund that Jamaica has implemented, would you say that those are credit positives?
They're credit positive in the sense that, I mean, if you look at Jamaica's growth rates year on an annual basis, a lot of times when you see a slowdown in growth, it's driven by flooding that affects agriculture sector. So even though it's very, very small as a share of GDP, the impact that it has on overall GDP growth is quite large and significant. So to the extent that these funds can mitigate some of those risks with the not necessarily a significant hurricane, Category 5 hurricane that hits a part of the island that is important for economic activity, but can sort of smooth out the effects of these more intermittent weather events. It's positive. These they come with a cost, right? And I think that's why you maybe haven't seen it more widespread. I mean, Jamaica is developing a contingency fund as well, right? So taking money from their budget, from revenues, it's put into a fund that then can be used for when a natural disaster hits. And St. Vincent does something similar where they earmark funds from, I think it's VAT on tourists or on hotels that they earmark for this contingency fund as well. But it's hard when you're an economy, an island that you either have low income levels or high poverty rates, or you have needs for spending in terms of education or health, to explain why you're diverting funds from the budget for those categories and into a contingency fund. So there's a sort of incentives problem, I think, that makes it difficult. And again, these funds are used more for smaller storms that have not necessarily as large of an impact on the economy, but it is credit positive in the sense that it will help to smooth out some of this volatility that we've seen in these countries.
And thank you for making that point, David. And the reason why I wanted to highlight that was because, we have on the one hand these locked in sea level rises that are credit negative, that, we're pretty sure we're going to suffer some of these effects. And so it's important to understand what we can do to counteract it, because the credit rating, of course, will affect your access to financing for development purposes or otherwise. And so it's important to understand what we can do to counteract these credit negatives. And I also am happy that you highlighted it, because I don't think, yes, there is a challenge with the incentives that you just discussed, but I don't think that enough governments fully recognize acknowledge and therefore amend policy or enact policy to address the whole climate resilience and recovery issue. Now, we spoke about Jamaica and St. Vincent and the Grenadines, but I'm sure you would agree that it's not as widespread as it ought to be. These funds that are set aside. Yes, we have the CRIF, and we have other disaster mitigants in the region, but I don't know that enough is being done in all countries. How would you respond to that?
Yeah, well, I'd say that, I mean, governments are aware, right, that they're exposed to these shocks, right, to climate change, and again, they are taking measures to reduce the vulnerability after the fact. They're taking steps to improve the quality of infrastructure, to increase its resilience to weather events, including improved irrigation, raising or increasing the quality of building codes over time. So these are positives, but again, I mean, it comes down to if you take two sovereigns that were similar, the same, but one is exposed to to climate change or to hurricanes or weather-related events, and one isn't, it's clear that the one that is, that's a vulnerability that the one that is not exposed doesn't have. So it's still a challenge. I don't know that you can do enough, right? I mean, it depends on the magnitude of the storm, but you're seeing steps at least in a positive direction to reduce the impact of these, what we know will become more frequent storms, more frequent weather events. So I think that governments are aware of the challenges, and these are all positive steps, at least initial steps, when these funds are fully built up, when they're fully developed. But again, it doesn't take away the risk of a more significant storm hitting that you couldn't have enough in contingency funding lined up before the fact.
I guess all I'm saying is that I wish it was more commonplace rather than the exception that we have these contingency funds. So let's talk about the catastrophe bond.
Mm-hmm.
And what are your thoughts around that type of an instrument? For example, Barbados in their recent debt restructure, that instrument does have a contingency for should there be a natural disaster. And I believe the one in Grenada, if memory serves me correct, as well, that there is then a moratorium on principal, if not interest as well, payments for a certain period of time, depending on the category of storm and the extent of the damages. But these types of financing are becoming more and more widespread, not just in the Caribbean, but elsewhere in the world, because I mean, everybody's being affected by this. And if you could share with me your thoughts on this development.
Yeah, I mean, catastrophe bonds is just another form of a risk-sharing instrument, right? So similar to CRIF, but it's slightly different, right? Where the coupons are delayed depending on a storm hitting, but essentially they perform the same function. It's a source of liquidity, or reduces a drain on liquidity or financing that the government can then redeploy for reconstruction after an event occurs.
As opposed to defaulting, which
exactly,
is what happened in Grenada, yes.
Right. And it does seem that more and more sovereigns are discussing this. I mean, Jamaica, part of this package, they're looking at this with the World Bank, I think. But there's a trade-off. And so if you're a country with already high debt burden and a high interest burden, that you're diverting a quarter to a third of your revenue just to service debt, these catastrophe bonds usually have a higher coupon attached to them than a plain vanilla bond. So again, it's this incentives issue.
So
it's a challenge where it's a trade-off between exacerbating or worsening interest affordability and having the scope or the flexibility after an event occurs, that you can then delay a coupon payment. You can have more financing available for reconstruction.
Yeah, but on the flip side to that, as an investor in the bond, one would think that I mean, all other things being the same, if you have a choice to invest in a plain vanilla bond versus a catastrophe bond, I would think that the risk of default is lower with a catastrophe bond. Um, or when I say default, I mean disorderly default,
Mm.
of course, than with a plain vanilla bond. And therefore, one can argue that that trade-off should not be the case. Yes, you will be making allowances in the event of a catastrophe, of a natural disaster, of a hurricane, and so on. But at the same time, the benefit of having that catastrophe bond is that you know that it's more predictable what your flows will be like, what your cash flows and coupon payments would be like, as opposed to a higher risk of a disorderly default.
That's definitely the advantage of the cat bonds, as they're called. But again, it comes down to also the size. So if you look at a country's total debt stock, and only a very small portion is in catastrophe bonds, well, the I'm not sure if it changes the risks as much as if a larger share of the debt had these features, right? So it's a very small sliver of the total debt servicing needs of a country, then the overall impact may not be as large. So that's the other factor to consider.
That's
But
true. That's true. Do you think that over time these will become more and more the norm in terms of when governments have to raise money, governments like ours in the Caribbean that are exposed, countries that are exposed to these natural disasters? Do you see this as becoming more and more commonplace?
it's something that if the costs came down, it would be more attractive. I mean, I know governments are working with international donors, World Bank, others on these programs and structuring these products. But over time, if they can bring the cost down closer to the cost of other borrowing, I think it would be attractive or more attractive for an issuer. But again, I mean, I go back to this issue that for a government that's already constrained fiscally, it's
Hmm.
hard to justify the additional cost, even if it may be rational for a longer period of time.
Indeed, indeed. What are your thoughts around, we talked about these contingency funds. Uh, of course, there is a trade-off with these as well, where you're prioritizing putting aside money and saving as you would in a sovereign wealth fund versus spending on immediate development needs, doing business reforms, uh, and that kind of activity that can actually arguably generate growth now versus growth in the long term, or insulate growth in the longer term. And so that's a trade-off that many governments, have to bear and have to consider. Guyana, for example, I know that they passed the legislation for a sovereign wealth fund. I don't know if it's actually been funded. Suriname as well, the Turks and Caicos Islands, and well, Trinidad, of course, has had one for a long time. And generally, having these types of funds, whether specifically tied to natural disasters or just general sovereign wealth funds, I know that these are, in general, credit positives. And also, I remember once reading a study that, and it makes sense, it's intuitive, that countries that have these funds tend to have more stable macroeconomic trajectories, because you have less of that fluctuation from the fiscal fiscal deficit ups and downs, as well as the business cycle ups and downs that you can manage with this one. Why? I mean, apart from, of course, the trade-offs that I highlighted about, I guess the policymakers in the first place having these demands from their constituents for spending now, but also politicians in general. I suppose there is a focus on re-election. There is that electoral cycle, and that has all kinds of implications. But what are your thoughts around sovereign wealth funds and funds in general, and why are they not much more commonplace than they are? Any thoughts
I
on that?
Yeah, I mean, well, so sovereign wealth funds are slightly different. Like in, I don't know Guyana's case,
Of
but in
course.
Suriname's case, it's not funded yet. But the idea is that only a certain amount of revenue from the mining sector, natural resource sector, will be able to be used in the budget, while the rest goes into the stabilization fund or sovereign wealth fund. So it's different than a contingency fund in a country that's trying to build up a buffer against natural disaster, in a sense that they're not having a surplus revenue or a surge in revenue related to one sector that they are then trying to limit how much spending can be done uh, against that revenue. So there's a slight difference there, but
There is,
um,
yes.
and they also, you don't see countries generally try to, they don't draw down on their sovereign wealth funds as often, right? I mean, in the case of Trinidad, they've done it twice, but then there's a lot of a focus on, are they using it for the right purposes? So you see countries that build up these buffers, they tend not to use them too often uh, in the Caribbean, in the case of Trinidad, and then they're really more targeted in terms of uh, controlling how much spending is associated with revenue, with a revenue stream that they know won't be there in perpetuity, right? So whereas contingency funds are really addressing funding for disasters they know will occur in the future.
Mhm.
They're both positive, right? From a credit perspective, the sovereign wealth fund case, because you have it to smooth out economic shocks, and contingency funds the same reason. It smooths out economic shocks, a particular shock. But when you for the countries in the Caribbean and more globally exposed to weather related events, contingency funds are really only used for the small to moderate sized uh, economic shocks. The cost benefit analysis, it doesn't make as much sense to have a buffer that would cover, you know, the most severe storm a country's ever experienced in their history. So it's meant for a certain type of weather event, not
Yes.
necessarily to protect against something that's going to affect 200% of GDP, or something of that magnitude. So it's very targeted for a particular size storm in terms of impact, or sized weather event in terms of impact.
Maybe we should be planning for 200% of GDP. Because, I mean, your research as well as others suggest that it's going to happen. It's really just a matter of time. Um, and that's the scary part. I remember Prime Minister of St. Lucia, Alan Chastanet, saying at an event, I believe it was last year, where he was referencing uh, what happened in Haiti in 2010. Of course,
Mm,
earthquakes have nothing to do with rising sea levels, right? But what he was saying is that, there was an event, I think it was at the IMF, if memory serves me correct, and he said, they're showing all of these people who were living in cardboard boxes in the aftermath of this disaster. And his point was, you might look at that and you might say, thank God that's not me. But then the point he made was, all of us are living in cardboard boxes in this region, in the sense that we are just as vulnerable. It's just that it hasn't hit us yet. And I think the whole audience, I mean, because there was that image
mm,
on the screen, and I think the whole audience just got very quiet. You could hear a pin drop, because he's right that Hurricane Dorian passed over Barbados before it went to Bahamas, and it looked on the satellite image like Barbados was inundated, and
mm,
really it wasn't, and we were so blessed. But then to think just a day or two later hit Bahamas and absolutely devastated Abaco and Grand Bahama, for example, it's really, really one of those surreal things, and makes you feel, on the one hand, of course, very lucky and very blessed, but on the other hand, you're very, very uh, aware, and it's very, very real that it's gonna be you one day. It just,
mm.
today wasn't your day. And so I feel like the governments in this region ought to be planning for 200% of GDP in terms of the cost of a natural disaster. even if it's not going to happen today, it's going to happen at some point. And I hope that that becomes more and more of a priority going forward for some of these governments in the region that really, I feel, have not sufficiently acknowledged this challenge and put aside what's necessary to address it. But yeah, I mean, I really appreciate that you and that Moody's has done this report and have highlighted the risks, not just as we know from a social perspective or an economic perspective, these risks that we face with natural disasters, but that you crystallize it into these are the risks from a sovereign credit rating standpoint. As you have done in the past, for example, around demographics and aging. And I thought that was a very, very important report. And sometimes we don't think of the connection between these two. So I just want to say thank you that you've done this report that connects the risks that we face on the natural disaster side versus the credit rating side and how the two connect. And that we could have had this discussion on what can we do about it in order to help mitigate some of these risks and the buffers we can build and the catastrophe bonds and the other instruments that help us to mitigate the risks that we face that we know will materialize. It's just a matter of time.
Yeah, no, I'm always happy to do these videos, and it's something, whether it's climate change or ESG, environment, social, societal governance, these are factors that are crucial to sovereign credit ratings. So we have to look at them. We're looking at them constantly. They're incorporated in all of our analysis now, and I think you'll see more of this in the future from us and from others as ESG, as climate risk gains more and more attention. But I'm glad you enjoyed the report, and always happy to do these videos with you.
Thank you so much, David. I really appreciate it. Thank you very much. Take care.
Bye.
Bye.